Hello, everyone. Welcome to another edition of our weekly commodity podcast. And I am your host and guide Ravindra Rao, heading the commodity research desk at Kotak Securities. Well, the much awaited US CPI print was out last week. The higher than expected US inflation data reinforced expectations that the Fed may remain aggressive with its rate hiking cycle. Although the year-on-year number dropped for a seventh month in a row as it eased to 6.4% in Jan, the decline was lesser than forecast of 6.2%. Disappointing US inflation helped the US two-year yields, which rose to a three-month high of 4.61%. Initial reaction to the US CPI data was negative for dollar as it eased market fears of a hotter inflation reading, pushing the greenback to 102.58. However, a decline in the greenback was reversed thanks to the hawkish comments by Fed officials. Also, US producer price index rose 0.7% month on month in January, beating expectation and witnessing the biggest increase since June, fueled by a 5% rise in energy cost, while core PPI increased 0.5% compared with the expectation of a 0.3% increase. However, if you look at the weekly performance of US dollar index, the rally didn't sustain as it gained by just 0.30% to close near 103.90. Largely, a positive economic data from the US and hawkish stance by several FOMC officials has opened up the possibility of more rate hikes by Fed, while pushing back expectation of a rate cut in 2023. On the technical front, US dollar index has been trading slightly higher, but I would say it is creeping higher. It is not sustaining at higher levels. We are seeing selling coming in at higher levels as well. Which we saw on the last day of the previous week. The resistance is near 105.20, which is the 252-day moving average resistance. So there is a possibility if the data surprises this week, we might see some pushback on the higher side. Otherwise, we expect dollar index to trade between 104.50 to 103.50 for the week. Coming to the commodity specifics, in case of precious metals, rising short-term yields and a higher creeping dollar have put pressure on both gold and silver. Gold prices have come to a 6-week low in the previous week to around $1827.20 per ounce. Higher CPI and PPI figures in the US provided further evidence of a sticky inflation, boosting dollar and treasury yields. Widely watched CME FedWatch tool shows US money markets now expect federal funds rate to climb to 5.2% in July from 4.5% to 4.75% target range at present, and compared with a perceived peak rate of 4.9% just ahead of the FOMC meeting. Silver slipped to $21.17 per ounce, lowest since November 2022, closing the week 1.3% lower, hurt by weakness in both gold and industrial metals. Minor inflows of 33 tons were seen in iShares Silver Trust ETF holdings, but that also couldn't help cushion prices. Although the price of both precious metals fell, the weekly close was much above the lows. Focus for the week would be on US preliminary GDP and FOMC minutes. However, we feel that a near-term bottom in gold and silver might be in place, looking at the bounce back that we saw from the lows on the last day of the week. And this might trigger some kind of a technical bounce. Having said that, technically gold has a good support in case of COMEX gold. It has a good support near 18 near a dollar 18 odd levels, which is the 252-day moving average. It has on daily chart, it has created two green candles, and the Friday's candle is like a hammer, and if it sustains above 18 dollar 18 53.54, then there is a chance it might move higher till 1860 to 1864, which is the 52-day moving average, and good resistance. In case of MCX gold, prices came below the previous highs of 56,190, but then it was swift to recover from the lows and it closed above 56,200 now, which makes 56,190 to 56,000 zone a good support zone. And if it sustains in the week, there is a possibility it might give a pushback towards 56,500 to 56,600 levels. In case of silver, prices have although prices have closed below the 250 today moving average on daily chart, a hammer has been created, and if it closes about 21.80, then we can say that it is a false breakdown, and the prices might again move higher close to 22.50. And in case of MCX silver, um, price has taken a support near 64,800 zone, and it has given a good bounce back. And if it sustains above say 66,000, there is a possibility it might, sorry, if it sustains above 65,700, there is a possibility it might move higher towards 66,200 to 66,500 for the week. Coming to energies, crude oil prices remained under pressure and closed 4% lower in the previous week as markets assess higher US stocks and prospects of further Fed policy tightening against signs of improving Chinese demand. As per EIA estimates, US commercial crude oil inventories increased by 16.3 million barrels from the previous week to 471.4 million barrels, highest since June 2021, and about 8% above the 5-year average of for this time of the year. Besides, export from Turkey that were disrupted after it was hit by earthquakes resumed on February 13th. Both OPEC and IEA revised their 2023 global oil demand growth projections higher by 1 lakh barrels per day from last month forecast, owing to expectation of Chinese demand growth with both positive and negative factors. Um, uh, we expect crude to trade in a broad range for the week. On the price front, WTI crude might take support near the previous week close of 75.30 dollars per barrel, and if it closes below that, then we might see further drop towards $72, $73. If not, then it might again try to regain $77 level, and if it sustains above that, we might again see prices going higher till $80. So it looks like a broader range trade in crude. So we have to wait for a break below 75.30 on a closing basis for further downside. Otherwise, we might see some kind of consolidation for the week. Finally, coming to base metals, LME base metals traded mixed in the previous week, largely hurt by prospects of higher interest rates in the US for a longer period. Copper closed the week with nearly 2% upside, helped by lingering supply disruption concerns. Aluminium slipped by 2% and closed below $2,400 per ton, hurt by sharp increase in inventories at the LME warehouses and no enforcement of feared output reduction in Yunnan province yet. Metals may get some support from hopes of more stimulus measure in China, as authorities said they will craft policies aimed at stimulating spending on housing, while PBOC stated it would encourage financial institutions to lend more to private sector businesses. Technically, copper has taken good support near 760 and has closed above 770, which was the immediate resistance. So 770 would now become the support, and on the upside, 778 to 780 would be the resistance. So the trend slightly looks, I would say, sideways to positive. So it has to go below 760 for further downside. Otherwise, we expect a consolidation between say 785 on the higher side and on the lower side 760, 765. In case of zinc, prices have moved higher from the lows, and there is a bullish engulfing pattern formation on a daily chart. But it has to, for the confirmation, it has to close about 272, and if that happens, then the bulls might once again try to push it higher towards 275 and 278. The recent low, which was hit around around 266 would be the support. Uh, it might move lower only below that. Otherwise, we might see a pushback towards 276, 278 levels. So, to conclude, focus for the week would be on US preliminary GDP, which showed a sharp rebound in the previous quarter despite higher interest rates. FOMC meeting minutes and core PCE, which is the Fed's preferred inflation gauge, will also be closely watched to see if price pressures have continued to moderate. Flash manufacturing and services PMI from major global economies may drop earlier. More hints on the economic activity in the month of February. Well, with that, I come to the end of this podcast. Good luck and trade safe.